Thank you for watching Resource Talks. It is the end of the week, so it means it's Junior Mining Talks time. But of course, we're going to talk about nothing before I've warned everyone listening that although none of the companies mentioned or featured in this publication have paid us to talk about them in this episode, this channel is a business. This channel earns its money by charging junior mining companies for interview production, which means there is a high probability that some or even all of the companies that we will cover in here have either paid us for such interviews in the past or might pay us in the future to conduct such an interview. In addition, all of us are junior mining speculators, both Luke and I, which means we may own shares of companies mentioned in this publication, or we may have owned shares of them in the past, or we may own shares of them in the future. All of this is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be at least some type of bias in what we say in here. This entertainment program is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business. That's not something in most of the cases that you can call investing. That's why I'm emphasizing on speculators. And losing money is the norm and should be the expectation, as this is a very complex sector and the performance of individual companies typically depends on many different factors, including geopolitics, macroeconomics, commodity prices, and so on, but also company specific factors like the geology and the management and the jurisdiction and the laws and this and that, many other factors, most of which are not really foreseeable. Unfortunately, and believe me, I have tried, I don't possess any superior knowledge, and my crystal ball seems to be broken because I don't know anything about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sort for that matter, as this is going to be a conversation that is general and impersonal in nature between a couple of individuals, none of whom are licensed financial advisors and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So before continuing on, please talk to a professional investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.ca, where you'll find the company's official filings. And if you don't do that, you're highly likely to lose your money. That said, Luke, I'll bring it over to you because today you told me you want to talk about 100 baggers. So I'm all ears. I actually don't know what we're talking about because you just told me I want to talk about multi baggers, centi baggers, if that's something you say, but yeah, 100x and stuff like that. So where's this all coming from? Like, why do you want to talk about these things? What brought up the idea?
Yeah, I've always been fascinated by very high risk, very high return stocks. And um, when I when you think about these things when you're a 15-year-old, I think I was 14 or 15 when I started buying stocks. You really want to get rich, and when you're in your 30s, it's more prudent to talk about wealth creation. I think it's the same thing, just different language. And I think when you try to really most people want to do this in a very short period of time. So there's a very big gambling aspect to it. And you really feel every day like every day offers a new chance to really strike it rich. And there's a lot of risk, I think, involved with trying to do it. Um, I've tried it from my 14, 15, and of course failed miserably for a very long time to find these 100 baggers and 10 baggers. I think most people are not lucky enough to really strike it rich. And if you're lucky enough, then you probably put your money into another stock and lose it again. So I think the only way to really do it is to study really hard at something you're good at. And Ian Kessel has studied 100 baggers for many years and has started events about it. He invited Chris Mayer, who presented his 100 bagger at an event. You can find the video on YouTube. It's 8 years old, where he talks about his book 100 Beggars in Business, and he's not really looking into junior mining at all. He's just studied 100 beggars that occurred in the past, and in most cases, these things take at least 16 years to play out, 16 to 30 years, and but sometimes it's even 30 to 45 years or more than 45 years. And there's also a number of them that they studied between 1 and 15 years. That's also a fairly small number.
Hmm.
And since I realized it's not easy to find these things, I moved my attention to the pink sheet stocks where I was trying to make these returns in 2 days because 16 years that felt like a lifetime to me at the time. 16 days felt like a long time, and I say it jokingly, but it's not far from the truth. I was really looking for these 10 to 100 baggers in days or weeks, and of course that's a couple of years ago in the meantime. But the presentation that John Mayer gave also shows that the type of compounding rate you're looking for. You need like 20 or 30% compounding rates for many, many, many years to make a 100 bagger. And is that really how it works in junior mining? Do you have these 30% year over year over year? And my conclusion is in most cases not. I can probably give one or two examples where a producing company was built. Northern Star, I think, was sort of a slow starter and started growing more rapidly. I think other businesses also do not behave like that, where you have 30%, growth rates every year. Of course, in the beginning it goes faster, but in junior mining it really goes typically it goes very fast in that first year when it starts moving, and that's typically a discovery. So I made a bit of an overview, looking at how long would it take to in a sort of normal business to make a 100 bagger versus a junior mining company. And that's what fascinated me, and that's why I put some information together to have a look at it together.
I see that you've put Paladin in here, which I believe is Rick Roll story time type of thing, where what did he say? Like he bought it at 10 cents, went to a penny, and then it shot up to $10. Notoriously, he didn't hold all the way through, so that's maybe something we'll talk about as well. Like if it happens, are you really going to be holding through? I know you wouldn't, because based on our conversations over the last couple of years, it's basically that's not how you handle these things. But what are the odds? Like could we put this into data? Because to me, it seems easier to teach a rock to find its own gold than to teach me to find a 100 bagger. So what are the odds that and I mean, I say I because you kind of know me at this point, what are the odds I'm ever going to find a 100 bagger?
Yeah, I think finding it, a 100 bagger, of course, is extremely rare. But the chance of finding it in junior mining is easier in a way that you probably read about a stock, like it, or maybe not like it enough, but think about it, and a couple of years later, not owning it, the thing became a 100 bagger. That happened to me probably a number of times. And 10 bagger happened many times. And in many cases, I even owned it for a while, but sold it too early. So you're right. I do not often own a stock for 5 years from 10 cents to $10, because it's, in a way, I think that it's almost a crazy strategy, thinking how much can go wrong. On the other hand, you have these stories where, because of the quality of a discovery hole, you could perhaps stay around, at least with part of your capital, until the thing really becomes $1 billion or more. And in this Paladin example that Rick Rule bought at 10 cents and indeed bought more at 1 cent, I think the key thing here was also a uranium price thesis. And I'm not really a guy who follows, well, I do follow the metal prices, but I don't really make a big thesis on a metal and then invest accordingly. I just invest in junior mining stocks, and management is a big thing for me. Capital structure is a big thing. So it's not really that, like many people on Twitter, who really like the uranium thesis and invest accordingly. And Rick Rule often jokes that people have a long-term thesis but invest very short-term minded. They expect something to happen overnight. So I think there's always the struggle between holding a stock for a very long time in this very risky business, very dilutive business, but you need to hold it for a while to make 100 baggers. That's always the difficulty. And I guess Paladin Energy, I would never have been able to pick it because it's simply not my type of strategy to bet on a metal, I think, or on a mineral. In this case, uranium did really well, and finding the right stock to play that uranium move, I think was an amazing bet by him 20 years ago. So yeah, 20 years ago, I think. But in this case, it's not just a company building. It's a company building. It's the price of the mineral, and it is everything playing out in the right time frame. So to make this is a 1,000 bagger, so that's even more unique.
Well, there's I don't know how many 1,000 baggers there are in the junior space, but it's definitely not a lot. This is one of those kind of legendary, mythical things that happened. Yeah, uranium was basically a mania at the time. That's one thing, but they also went from an explorco to production, if I'm not mistaken.
Yep.
So that also kind of changes things. That almost never happens. Like the chances for one company making a discovery and then putting it into production within the same commodity cycle with like a complete mania behind the price of the commodity. That I mean, that's lightning strikes more often, right? I mean, this just doesn't really. It's an interesting example to look at, but I don't, I don't know if there's any guidance in it. And that's something that I probably wouldn't have said just like 3 years ago or something. I would have thought, like, I would have believed I was the guy that would strike a 1,000 bagger. The market is a humbling experience, unfortunately. So, like, I don't really see any directional guidance in this.
Well, maybe realizing that there was not even a Lassonde curve in here. I mean, they moved it to production without really losing a lot of market value. Maybe the biggest drop they had was from 460 to about 320, which is maybe 30 or 40%, well, 30%, I guess, which could be painful if you're in it with a big position and you start wondering, is this the end of it? But really, there were no major drops like 100% down, and then it was really positioning. I think in the early days, like Rick said in a couple of interviews, from 10 cents to 1 cent, that's crazy, and you have to load up again to really position yourself. I think that's when in Canada often a rollback follows, and you completely um, get in trouble. And if you do not position again, if you still believe in the thesis. So here, indeed, you have a uranium price moving up for several years, a company building, building a real company. It's not just a promotion, building a real company over this period of 4 or 5 years and getting all the permits. So everything just worked out. And I think it's extremely rare indeed. And that's why both of us, but certainly not me, I will probably never experience something like this because I'm too skeptical, and I just realize that the risks are so high that I wouldn't wait for this complete period. If I look at this chart, I would think in 2006, if I even held it for 2 or 3 years at that point, I would have doubted that the uranium price would go even further, and probably would have taken profits. That being said, I'm often in stocks for 2 or 3, 4 years, but that's including the wait time for things to kick off. And of course, in Paladin's case, it also took a couple of years before the thing even started moving. And that's often the first 1 or 2 years I'm in a stock, and then you know waiting another 2, 3, 4 years to play out, especially in this market, is tough. Knowing that metal prices sometimes get crushed, and then you are part of this company.
Hmm. There's others. I mean, Paladin is not the one. A Great Bear went from 5 cents to $30 or something like that. Kirkland Lake, Silvercrest. What else? Northern Dynasty. There's a couple of ones that have like these type of moves. Is there anything that you can see in there that's a common denominator besides luck? I suppose. Like, is it insider ownership? Is it a booming market? Any common denominator?
Well, I've been looking at insider ownership, and in my personal experience is that people, if you don't have that insider ownership, if you don't have people really caring about the company, in most cases, these are not the people who will make the discovery. It does happen, but not very often. If I just look at statistics, companies that recently went up 2, 3, 4x, and I compare their insider ownership to the ones that didn't do so well over the last 2, 3 years, I do not see a very big difference, just on average in the numbers. So I think you really have to dive deep into this thing. In Great Bear's case, they rolled it back twice, 1 to 5. The company was started in before 2010 already, and if you look at the numbers, they rolled it back twice. So in 2011, the stock was trading between $1.50 and $8. Of course, it wasn't because it was trading at a couple of cents. But if you include those rollbacks, the current price, or let's say the last share structure on that basis, it was trading between $1.50 and $8.75. Imagine buying Great Bear at $8 and seeing it go to 5 cents.
Hmm.
If you're probably going to sell at 20 cents to just have a little bit left and move on. And then, but of course, typically the moment to position, if there's a real plan going forward, maybe a new project, a new team, is after a rollback. Soon after a rollback, you typically see a financing. That's often when things turn around. But of course, no guarantee for a discovery. So if you really want to be part of this 100 or 1000 bagger, you have to be in before discovery. Otherwise, you pay typically 3, 4, 5, 6 times the price, and you can still, in most cases, bet for a 10 bagger, but no longer for a 100 bagger. And in my opinion, trying to do this, it's really, the odds are really slim, and you can just look at it by the number of companies and the number of companies who can give a return like this. In the last 3 years, there were, out of 1,200 companies, only 50 companies up more than double. So 50 companies out of 1,200 are up more than 100%, which is, telling. Of course, the last 3 years were not amazing. And if you look at 2020 until now, there were 166 companies still existing out of the 1,100. So 10%, a little bit more, 16% of the companies that still exist. So the odds of even finding a double is quite slim over a long period of time. And realizing it makes the chance of being in a 100 bagger way lower, because you typically don't have the staying power until the complete thing is done. And but it's still fascinating. And I think the highest likelihood of being in such a stock and staying in such a stock is when you already have high confidence in the beginning of the discovery. Like, this is a groundbreaking discovery, is something truly unique. And maybe Snowline is something like that. Great Bear wasn't completely obvious to me because they were drilling in Red Lake, and Red Lake is not very easy. You can see it with Pure Gold, which is now West Red Lake. Sometimes you hit a high grade and then the next time, you miss it again. It's not very consistent. It's not very wide. But what Great Bear found was a different type of system. And the moment people realized that, that's when the stock really started going from $2 or $3 to $30. So it was not on day one clear that it was such a discovery. Initially, it was maybe a Red Lake type discovery. And that's why these longer intercepts, fairly high grade, but long intercepts like Rupert Resources and Reunion and Snowline, if you are already in a stock like that and you have a drill hole like this, then that's when I would have more staying power, because you think, okay, these things typically do not happen, and you miss the next hole again. Could still happen, but that's less likely with a 100-meter hole versus a 10-meter hole.
It's kind of like listening to you speak here, and I'm mostly thinking about a joke, but it's kind of like it's like getting even a 100x. I'm saying even a 100x, but getting a 1000x definitely is. But it's kind of like a unicorn, right? It's magical, and everyone wants to catch one. But the closest you're going to get to it is listening to Europeans talk about it on the internet. It just doesn't really. I don't know. I've heard a couple of people get it, but there's nothing. There's more luck than science in getting these exceptional returns. That doesn't mean that you can't do well. I mean, if you do the work, I believe you still can do well. Just the odds for an exceptional return don't really seem all that high. And on insider ownership, where you began, I've actually stopped caring about the absolute insider ownership as much as I care about how important the investment is to the insiders. So you can have a 10% insider ownership, but if that's 100% of the CEO's net worth, they still may work way harder than if you have a 20% insider ownership, which is double, but it's like a drop in the bucket for the CEO, if that makes sense. And that's not something you can, I mean, there's no data to go and look at on these things, but I think looking at some of the examples or thinking about some of the examples, Great Bear, Kirkland Lake, Northern Dynasty, and Paladin, the people running the company were very leveraged toward the company. It was kind of a make it or break it type of move for almost everyone involved in the company. So maybe that's part of the common denominator.
Yeah, and even if somebody is very wealthy and the share position is not so meaningful to them, it's still important, I think, because it would also improve the share dynamics if you have a strong team behind it that together with five people hold 20 or 30% of the stock. That in general gives confidence to the market and allows people to buy the stock because they have more confidence in it. So I think it's often a self-fulfilling thing. Of course, when you have typically you have the wealthy people backing it, not running it, and you want to have the guy running it, the CEO typically have a big position, and a big position for me could be, I mean, it depends per company. But you want to really have confidence that it's important to him and that this guy is not running five companies at the same time. And in terms of trying to find it, I took this example of this image that I created today, and it's a little bit my philosophy as well. I'm also playing. I buy a lot of greenfield stocks, but I think about timing. You know, I'm often in the story early, but I would also sell a bit after initial run if the run is based on promotion or if the run is based on it, grounds, surface results, waiting for that holy drill hole um, to tell you the final outcome is tricky if that's the only hole that really, carries the value of this company. And I took this example of $10,000. You can find it in my slides, and you can show it in the podcast. Is if you're betting on these, this is just an example of a 10-cent stock or an 8-cent stock, where you would bet your $10,000. That's just an example of money people would bet in a high risk drill story, and you get 100,000 shares for those $10,000. And the other strategy is that you're buying post discovery. And my experience is that you don't only have the initial spike from 10 cents to whatever price, because in most cases, a company starts improving results. Great Bear was not that big hit, what started everything. They had a couple of good hits. It started to get better in August 2018, I think. That's when they drilled that hole that fascinated the market. Everybody got fascinated with the story, and Rob McEwen came in. That's when Great Bear really became Great Bear. And that's why you typically have at least a 3 or 4x. Not always again, but I found very often that when you see a discovery like this, you're not buying it because you feel like you missed the move. And that's because the story is already up 3x. So I took the example of 3x, this example of this chart here, where you see somebody buying $10,000, 100K. The other strategy could be waiting for something that really is good enough for you as an investor to judge, like, okay, this is meaningful, but you're paying 33 cents, more than three times the price. But that would also give you, in that case, more confidence to buy more, because if you're buying $10,000 in extremely risky drill plays, then in theory you should be willing to pay $30,000 for a lower risk play, right? Of course, this is very theoretical. And you could still buy 100,000 shares with a bigger position, but lower risk. And if you then would sell at the same time, you would still have the same return. Of course, it's a very simplistic way of looking at it. But I feel like buying the same amount of shares after the discovery, if that discovery is certain enough for you, then that could be a strategy to not play all these drill hole games, but wait for something that is good enough for you to invest a larger sum of money.
It's almost, I almost see it as a negative, actually, or maybe ironic is the best word, that there is a possibility of a 100x or 1000x return, or that we really have these names like the Great Bear. Like, how often have you sat in on a meeting or presentation, someone said we could be the next Great Bear? How many of them did actually become, or will actually become that? Not many, probably nobody, or like one in I don't know, 2000 or even less. So it kind of becomes like a weapon for manipulation. Like, on one end, it's positive, it can get you excited, it could make you do the work, But on the other end, it could also be kind of a manipulation tool for companies. The fact that it can happen, it gives juniors just enough truth to build a fantasy around. And I'm not saying everyone's doing it, but the possibility of a 100x is not very high, right? It gets hyped to oblivion, and that's often at the expense of critical thinking. Someone tells you, oh, we're in the same geology, you're in the same whatever, and then you turn off your brain and you're like, oh, this could be the next Great Bear. That's why I'm betting on it. And even though you might be doing it responsibly, which is using 1% of your portfolio, putting it into juniors, which probably too much for most people actually. It still is not a reason to not use your brain and use critical thinking, but it really is kind of how it gets used. And unfortunately, it works. I mean, until the drill results or the lack thereof goes back to the market, it brings back everyone to reality. It seems to work for a lot of for some of these companies. It seems to work. And yeah, I guess when a junior says that they have a 100x potential, they really mean their PowerPoint font size can go 100x and nothing would change, not your portfolio. So yeah, I don't know. I have a different, I have kind of confusing thoughts about it.
Well, if a company tells you that they could potentially be 100 bagger, then that would be a red flag. I don't want people to tell me at 5 or 10 cents that they think it's a 100 bagger. They should talk about what they're trying to find, and I will do my own sort of calculation what I think it could be worth if everything works out.
Mm-hmm.
And an example could be Vizsla Silver. I didn't find it myself. My broker came with it, and I bought stock at 15 cents. And I believe it was a full warrant, 25 or 20 cents. And that stock went to $3.50 and is close to $3.50 again, including the full warrant. That is probably 50 bagger, 20 or 40 or 50 bagger. I sold it just before the PDAC, just before before PDAC, but just before the COVID crash. And I felt pretty smart because I sold my shares and my warrants at about 80 cents, 80 or 90 cents. And then the thing crashed, 25 cents, 25 cents. So I was very happy that I sold. And then the stock went to $3.50 very quickly after they made the discovery. And Vizsla was not just a discovery story. They were thinking about this was an old mining district where they could already perhaps make it work with, a smaller, high-grade ore body that they could quickly bring in production. But they made a big discovery and they're building on it right now, and it's one of the best stories out there. Great Bear, I listened to Chris Taylor's first online presentation this week, just to think about like how did he present the story in 2017 or 2016. And by then he was running the company already for 5 years, but they bought this Ontario project and they had a couple of nice drill holes, also some unassayed drill holes. And it wasn't completely obvious. It was just a nice story with a low market cap. They rolled it back, so it had a good share structure again. And insiders were positioned, of course, after the rollback. So they got enough cheap stock to be positioned again. So it's almost like a restart when company rolls back. And of course, he was not promising anyone that it would become a 10 or 30 or 100 bagger. It became a 200 bagger. And if you really take the absolute low, it became a 500 bagger because it traded at 5 cents for a little bit. Even if you consider both rollbacks, it traded at 5 cents, which was probably half a cent in 2014. If you look back, so nobody should promise you that. You should really see a solid team with a solid share structure, in my opinion. Because if you have too many shares, too many warrants, again, I've talked about it too many times, then you're probably not going to get a 100 bagger. Depending on, of course, on your entry price. Reunion never rolled back and became probably a 20 or 30 bagger from their 5 cent price. So yeah, I think nobody should promise you that. You should really have an idea about what it could be worth if they make a big discovery and what the likelihood is that they're going to miss. Nobody really knows. And think about if they miss, will they be able to raise money again? How far will it fall back down? And what will happen if everything goes wrong? And since you think about all those risks, the likelihood of staying around, like I did with Vizsla, is difficult because with Vizsla I had a 20 bagger, including well, not a 20 bagger, I think 10, 15 bagger, including the warrant. And I was very happy with it until I saw the discovery later that year.
Hmm.
So it's not easy. It's not easy, but it's still fascinating, and it's still the reason that people come to the business, and it's still the reason people can make discoveries. Otherwise, if nobody bets anymore on a on a greenfields project, then nobody will make a discovery. So luckily, there's still capital available to these teams, and hopefully uh, you or I or both will be part of it before the before the drill hole and have enough confidence to stay, but understanding the risk, of course.
I like how you're making fun of me while making it seem like you're wishing me good fortune. I appreciate that. But it's no, it's not something I've just completely put out of my mind. It's not something, and I hope I'm going to be able to do that with the 10 bagger too. I'm still really stuck on the idea of, oh, I am going to have a 10 bagger. I kind of got an early taste of that last year now in 2024, um, where at a certain point it was almost a 10 bagger in my portfolio. It's given a lot of that back now, and I obviously have some thoughts and feelings about that too. But I am still kind of stuck on, oh, maybe I'm gonna get a 10 bagger, but I feel like I'm maturing out of it, if that makes sense. Um, so what is it like? What's a reasonable thing to hope for? Clearly, a 1,000 or 100 bagger is not reasonable, and for the vast majority of us, hoping for a 10 bagger is not reasonable. Hoping, strategizing, working, investing for a 10 bagger is not really reasonable for the majority of us either. So what is like what is kind of a target when you go in?
Well, I think you have to look for 3 or 5 baggers or more, otherwise it's not worth the risk in the first place.
Hmm.
You can never really know, of course, how it plays out. And when the founder's metal story was presented to me at 20 cents, I did feel like this will probably make me some money, but I felt it was drilled already before, and they will probably just twin it. And I was a bit skeptical on things, and I was completely wrong. And then in November this year, last year, we talked about it, and I was saying, well, I wouldn't buy it here because it's a pretty high market cap already for what they found.
It's
And
up
of
almost
course,
50% since then.
and
So
of course, it went up. I in this chart I made a purple arrow with our episode timing, which was just before it
mm,
spiked from I think $4, maybe 380 to whatever it is, 580 right now.
mm.
Pretty amazing. I see that they make discoveries. I still don't really understand the valuation. It's pretty rich. But apparently the market thinks this is the next reunion, and maybe that's true. Of course, we didn't rule out that that is possible. I just felt that it was pretty expensive for what they had, and it's more expensive right now. And it's amazing. I really don't have bad feelings about it. Of course, when when you get the opportunity to buy 20-cent stock and a couple of months later you see it at 60 or 80 cents, you feel, I was wrong, and it hurts a little bit, but it shouldn't hurt too much because there's always a new opportunity. And it's not that I'm not wishing other people well. Of course, I'm wishing myself well too. But no, I think there's the good thing is you can always look for these things. They will happen again. I can absolutely guarantee that this year there will be a big discovery again. You should just have money available and be very focused on the market. And if you're not certain enough, when you see such a news release, don't buy it. But if you are certain enough and you are in this business to take risks, then buy it. It's not very difficult, I think. The most difficult thing is if you're waiting for discovery and buy post discovery, do you understand the complete story and the market valuation and who owns it well enough to buy it on that first day because it typically spikes up? And are you confident, to say, okay, I'm willing to pay 20% more than yesterday's price or 30% more, and I still feel I have at least double potential for a double or triple. Because if you really feel like it's already getting to a valuation that I cannot see, I mean, they need to find an amazing ore body to even make a double. I wouldn't do it. But if it's a stock trading at 30 million, opening at 45 million, but they hit a snowline type hole, well, then of course it's perhaps reasonable to pay 60 million value in market cap, or to enter into a $60 million market cap company,
Hmm.
hoping for the thing to become a $500 million or more company. So I'm not saying anything special here, I guess, but I think the most important thing is having confidence in your own judgment of market cap people running it, and the discovery, even if you're not a geologist.
Hmm. What do you think about this new rule? The insider's position size should be 100x your exposure. As in, if you want to make a position of 1% position size, you should expect the insiders to have it as a 100% position, meaning you could almost never make a position of 1% position in your portfolio. I'm kind of thinking about that skin in the game thing that you said and how to quantify it. I'm failing in it quite clearly because that didn't make sense what I just said. But what, how do you quantify that? How do you quantify real skin in the game when someone will work as hard as, for example, the Founders Metals team has worked? Uh, how do you find it early on? How do you recognize it early on?
Well, you cannot exactly know somebody's wealth, of course, but you can make a little bit of an estimation looking at a person's career. If somebody already exited previous stories, how much stock did that person own at the time, and how many options? So how much money did they make from that company? If it's, let's just say, a company, somebody led a company to take out, and that person exited with $1 million worth of options and stock. Then the assumption for me would be that that person doesn't have a net worth of 20 million or something, or 10 million, or he was not really invested in his company. Because typically, when you include all the options, all the warrants, all the shares, and you have a takeout of 100 million or 200 million, and somebody makes a percent, was just a percent shareholder, it would either indicate that that person didn't really believe in his own business or wasn't super wealthy, either one of them. So in that case, if that person starts a new business, it's a small business, let's just say a $10 million company, and has, of course, they typically have founder shares too, but if they are buying in the market, even $5,000 at the time would be fine. But I want to see that person not just buying. I mean, you can sometimes see insider buying that looks like promotional buying. When a new company starts, IPOs, they have lots and lots of cheap paper and then start buying $2,000 here and there at that increased price. That to me hints a little bit like insider promotion. But if a person really, let's just say that right now we are in a tough market, a stock, didn't do well, landed somewhere at 5, 6 cents, and the insiders really started buying stock from 15 cents, 14 cents, 8 cents, 7, 6, and they're not doing cheap issuances with lots of warrants and lots of shares, but rather they're buying stock in the market because they think the company is cheap. That would be a good starting point. And if they also prove that, for example, 6 months ago they did a financing without a warrant or half a warrant, and you talk to them and you ask, like, how did you set up this financing? Who bought it? And they say, well, I've got a good network and I got my friends into it, and I feel like they are long-term holders. Nobody knows for sure, and they give you a reasonable answer on who invested in his company, and they're buying in the market, and the projects and the plans, what they're going to do are, they make sense, and you can buy close to the all-time low or close to the 52-week low, and you think it's a good business plan in terms of junior mining business plan. That's when I get fairly comfortable with a company, because they are buying the stock themselves, and then buying $3,000 or $4,000 at the time, it could be enough. You don't necessarily have to see 100K here and 200K there. It's amazing. Like in Lavras, you see insiders buying, $100,000 here and there. That's amazing, but not everybody can do that. So in small companies with leaders who are not extremely wealthy, but are still buying stock in the market and have a solid plan, and preferably a strong backer, that's often a good place to start.
Well, you bring up a very good point because it's not to say that if a CEO starts off as not being wealthy, meaning they cannot buy, hundreds of thousands of dollars of the stock in the open market every other day, that doesn't mean they're a bad CEO at all. What I'm really thinking or willing here is significant personal exposure. That's what I'm wanting here. Asking insiders to risk their entire financial future on one thing might be too much because maybe that kind of scares off the big talents and leaders uh, from other industries, maybe to join our industry or something like that, right? But at the same time, also, if the insiders don't have enough skin in the game to get a sunburn, then what are we doing here? Are they really just here for the shade? That actually might turn into a Rick Rule quote one day. Could be beautiful. But that's kind of what I'm thinking. It's all relevant, I think. I mean, you want them to be you want them to be significantly incentivized, but you also don't want them to be too stressed or be making decisions out of fear either. So the 100x rule maybe is too much. Maybe I need to tone it down to 10 or 20, 30. So if you want to make it a 2% position, you would expect them to have at least a 20% position, maybe something like that. I'll
No,
tinker.
I think it's I don't like that rule because that really depends on everybody's individual
True.
position. I mean, some people can take 5% stakes in several companies. Sometimes they have 20 positions or 30 positions in the portfolio where they have more than 3 or 4% of a company, and there's just a difference in wealth. In very small companies, I sometimes own a percent, sometimes I own 2 or 3%. But then you talk about small companies, and I'm looking at the CEO. I don't want to own way more than the CEO. That feels wrong because I have also 20 or 30 positions, and I don't want to be a big. I mean, with my current position and my net worth, I don't want to be a much bigger shareholder than the CEO. That doesn't feel good to me. But for an Eric Sprott, of course, that's the usual thing. Uh, it's really depends on the story, depends on the type of CEO, depends on your own personal wallet to decide what type of position sizing you have to do. But you want to have a CEO and preferably another backer who are really positioned and try to do the right thing. That's already an important start because there's many companies that's that's just designed to be promoted or
Hmm.
where I've seen a company that IPO'd last year at 70 cents, and the CEO was telling me that it was really cheap. It was a very good entry even after the IPO of 70 cents. And the stock is now at 6 cents. And I have seen a bit of insider buying recently, so that's good. But if you're not buying at 6 cents, telling me at 70 cents that it's, well priced or cheap or, that there's upside, then something is wrong. Either they are blacked out for a very good reason, and I don't typically accept that reason very quickly because it could be an excuse. There's no other excuse, to be honest. Then you have to buy the stock at 6 cents if you think it was cheap at 70, or something went really wrong and they admit that it went wrong. That could be. But still, they should buy it because they should have a new plan with it if they stay.
Yeah, yeah, that's fair. We're kind of coming up on our time that you promised me. You know, you have to run. It's a little bit shorter this week. People can let us know what they thought. I think some people like shorter, some people like longer. Um, and then yeah, let us also know what you think about insider ownership and how you treat that. Is it just an absolute percentage, and what else you think? I think the conclusion is that 100x, 1000x not worth chasing, 10x almost not worth chasing, 3 to 5x could be doable if you're willing to do a lot of work and lose a lot of money along the way to build that experience and knowledge. I think geology matters. We didn't talk a lot about that. I wanted to make a point about you potentially holding Vizsla. Like you may have hold Vizsla if you understood their geology or their geological potential. Maybe. I don't know, but we can talk about it next time I see you shaking your head. You just don't like geology, admit it. But no, that's it. Another thing, beware of the PowerPoint warriors that are telling you we're going to be the next 100x or next 1000x without talking about the specifics. Kind of easy for me. That's kind of obvious for me, I suppose. Not easy. Nothing's really easy when you're me, but it's kind of obvious. Insider ownership, we talked about that. Yeah. What else? What else to summarize it here?
No, I think that's it.
Hmm.
You can target a 10 bagger. I think you cannot target a 100 bagger. That's impossible.
Yeah.
If you can look at a stock and think with this outlet, this company, the way it's formed, the structure, and the projects into it, if they make its discovery a porphyry discovery, whatever type of discovery you could envision that company trying to find, you can target a 10 bagger. But of course, it's always the risks are very high and it's very rare. But I don't think entering for a 10 bagger is bad uh, if you understand that it's very unlikely to happen, and if you understand all the other risks that could, all the other things that could happen, and completely break the company, jurisdictional, drill holes, people leaving, whatever reason. But I think entering with an idea of 10 bagger is okay. Entering for 100 bagger is a bit rich.
And even still, a great project can still fail with bad execution, destroying destroying the share structure and whatnot, and everything else that we've talked about it before. So speculation is part of the game, and you need to have that drive in you, but it is fundamentals that are going to turn your dreams into dollar. I've been making a lot of quotes today. I should have written some of these things down. I'll listen back to it and I'll write them down maybe for next time. But thank you so much for your time.
Thanks.